Hi, everybody. Time for Markets on the Move. I'm Marlin Bohling with you, and I am joined, of course, by Oliver Sloup of Blue Line Futures. Oliver, you look well rested. I don't know if you are or not. You've been on the run all week long on the Pro Farmer Midwest Crop Tour. So good to see you back. I assume you're able to settle down for a little bit after a grueling week. Give me a recap from your perspective there.
Yeah, it's kind of a double-edged sword crop tour week. It's a love-hate relationship. It's really great to get out there and see everything for yourselves across multiple states. It's not very frequently you get to do that. But on the same hand, it's a long, long day. You get up early in the morning, which I'm typically used to, but the evening is what throws me off. I go to bed pretty early, but we've got those nightly meetings that sometimes don't get over till 9 or 10 o'clock. So, yeah, it's been a long week. Happy to be home and get some rest this week. But all in all, I think the recurring theme throughout much of what we saw was underwhelming. And I had a lot of clients and prospects kind of reach out and say, well, if it's underwhelming, why are we coming in with these big yields? And I had to point out that it's underwhelming relative to the expectations that the USDA set. They set the bar so darn high that it became very tough to meet those expectations. And I think that's largely what was seen not just on our route, but everybody's route. And Pro Farmer just released their national average estimates here just a little bit ago before we hopped on. They've got corn at 182.7 and beans at 53 bushels. So corn numbers, big difference from what the USDA put out a week ago, a week and a half ago, and talking with a lot of farmers along our route that we bumped into. A lot of them kind of hinted that maybe peak yield production was seen at the end of July, and then things started tapering off there, especially in Indiana and Illinois, where things started to dry out pretty good.
Well, the trade on corn for the last week and a half or 2 weeks has been coming back up. It seems like the trade was anticipating that you would probably find about what you did find, maybe not up to par with USDA's estimate there. But do
Yeah,
you
no,
think that it's all priced in now or not?
I think so. I think a large portion of it is, and we'll pull up the corn chart here on our Blue Line Edge trading platform. Again, this is the desktop version of the trading platform. We've got a mobile platform, great whether you're trading or just monitoring price action. This is a great tool. But as you can see, yeah, we have that big red bar down here. That was the USDA WASDE report where they came out with the high yield expectations, and I think that really, again, set the bar so high that the path of least resistance seemed to be walking that back, and I think the market's been doing a good job at pricing some of that in over the last week and a half. We broke out above the 20-day moving average yesterday, which is this purple line here. That's now going to be, I think, a significant support level along with this little pocket, the old lows from back here in July. So that 410 area, if we can defend that going forward, I think we can maybe carve out a little bit more of a well-defined low. As far as upside potential from here, probably somewhat limited. We're looking at trend line resistance right here, as well as that red line, which is the 50-day moving average. Both of those come in a little bit closer towards 420. So if we get some follow through to the upside after this week's trade, I wouldn't be surprised to see those levels tested. And at that point, I think maybe look at some downside protection, or if you've been long, maybe reducing some of that risk.
Now, on the soybean side, they had a pretty good run in the market here this past week. It seemed like it was driven by soybean oil, perhaps. Maybe you can explain that.
Yeah, soybean oil caught a big move. Some friendly biofuel headlines certainly kicked things off here recently, as well as just the technical landscape and broader fundamental landscape really changing from that WASDE report. You and I touched on it coming into that report. The story was that there wasn't a story, but dropping 2 million acres certainly changes the fundamental picture a little bit. And in turn, that also changed the technical picture. We got out above that cluster of major moving averages in the mid 1020s here, and that had acted and held as support, which is really what you want to see. And now we're talking about the top end of the year's range, which comes in the mid 1070s. So it's just kind of a reminder that things change very quickly in these markets. Just 2-3 weeks ago, we were talking about potentially making new lows for the year. Now we're talking about maybe making new highs for the year. All in all, I think this market continues to look constructive. As mentioned, some of those dry areas in Indiana and Illinois, it's still kind of make or break time for some of these soybean crops out there. So if they're not able to get a drink, potentially that adds a little bit more premium to the prices as well.
But with China not in the market for U.S. soybeans here. They haven't bought anything this year. That upper resistance level you have on that chart, that seems like that would be a tough nut to crack, doesn't it?
I think it would probably be pretty difficult to get out above there without any substantial progress on trade. With that said, I think the market's probably digested a lot of that information with low expectations of China coming to the table and making meaningful purchases of soybeans. If they do, obviously that would act as a little bit of an ace in the hole, but I don't think anybody's holding their breath for that just now.
Shouldn't we find some sort of seasonal support in the wheat by now?
The wheat market continues to be a little bit disappointing seasonally. We can try to carve out a little bit of a low here. Corn and soybeans did a good job, posting higher closes for the week. September Chicago wheat still down about 1.75 cents on the week, so definitely lagging the impressive week that we saw in corn and soybeans. If corn and soybeans can continue to find their sea legs, I wouldn't be surprised to see that spill over into a little bit of a tailwind for the wheat market. But as you can see by looking at this chart, the bulls have their work cut out for them. The 20-day moving average, you and I talk about that all the time. It seems to be a big one that the algorithms are watching in a lot of these commodity markets, not just the grain sector, but outside of that as well. If we're able to get out above there, and then these old lows, which was the breakdown point also at the end of July, potentially we can start to see a little bit of a short covering rally and see prices firm. But again, it's kind of one of those situations where the expectations probably should be tempered if we do get a little 30-40 cent pop from here.
Well, I hope you have some livestock charts at the ready here, because we had a big day again in the cattle market. Everybody keeps thinking, man, there's got to be a top in here somewhere, but it just keeps proving everybody wrong. How does it do that, and why did it go so much higher here on Friday?
We do have a cattle on feed report here out this afternoon. It'll probably be released here any second, actually. But yeah, the cash market continues to be very firm. I think you probably had some positioning ahead of today's report, but the cash market is really continuing to underpin this bull market, which, as you can see on this chart, is just up and to the right. It's borderline textbook, but these are very, very wide swings. But I think, October live cattle up 722 on the day. That marked 8 out of the last 9 weeks with a higher close. So definitely still intact here. We'll see what the cattle on feed report comes out as. But I continue to be impressed by this market with the way that the funds are positioned so aggressively long in what is a seasonally weaker time of year. So they've been fighting seasonals and pushing this market to all-time highs, which is very, very impressive. But we'll see what the cattle on feed report says. And then over on the feeder cattle market, just a huge run higher this week, up 17 bucks. And the feeder index for CME Group still a little bit below where these futures are. The real-time index is about 357, so you're starting to see the futures kind of get out above the index, which is interesting. It's really been a laggard for much of the year, but futures starting to price in more optimism.
Well, just as you were talking there, I did some looking on the wire, and I see it came across the USDA cattle on feed report. So here are the numbers. On feed, the average trade estimate was about 98.1%. The actual number came in from USDA at 98%, so just about right on the money there. Placements, however, the average trade guess was 91.1, and it came in at 94. Marketings were expected to be at 94.1, and they did come in at 94. So the only thing that was a little bit of a surprise might have been that placements number being a little higher than they thought.
Yeah, I'm going to probably call that a fairly neutral report, just going off by what you said. It sounds largely in line with the range of expectations, maybe a little bit off there on placements, but all in all, I think the market's going to continue to really focus on what the cash trade does going forward, and that has just been the gift that keeps on giving for this bull market. So it'll be interesting to see how far that continues to go. It continues to exceed my expectations, that's for sure.
So what about the hogs? As I look at the market close here today, hogs seem to follow along. I mean, it wasn't quite as dynamic as the cattle, but they've kind of needed a little help, didn't they?
Yeah, the hogs had been limited by the 20-day moving average for much of the day, and the consolidation has kind of been the word that I've been using for lean hogs as we just trade sideways, and the market's found somewhat of an equilibrium as of late. We got back out above the 20-day, which was good to see today. You can see here traded up to the 50 and trendline resistance. So we're at kind of a pivotal point going into next week's trade. If we can feed off of today's momentum and get out above that 91.75, 92 area, potentially you start to see technical momentum feed on itself and we can get this thing moving back north again. But a failure here, and we probably retreat right back into that range with consolidation continuing to be a major theme there.
I have to ask you about the financial sector today. A lot of talk about, well, that familiar location, Jackson Hole, Wyoming. They had their annual meeting out there, and Jerome Powell talked this morning. Did that was that the deciding factor that made the markets really go wild today, like on the Dow and the Nasdaq?
Yes, so the indication is that rate cuts are coming around the corner in September and maybe a few more before the end of the year. So you saw a lot of a risk-on trade start to develop in those outside markets, S&P, NASDAQ, the Dow, etc. And then you look over to the precious metals as well, and with lower rates, they caught a nice little tailwind as well. Here we have the gold chart pulled up, so you can see it was kind of on the brink of the lower end of the range, but a nice recovery from some headlines from Chairman Jerome Powell today kind of put us back towards the middle of the range. And then silver looks interesting too, looking at the December chart, breaking out above trendline resistance here. I think next week is going to be a very important week for the silver market. The September month is still front month futures there, but that goes off in about a week. Deliveries start, so December is really what we're keeping an eye on. With this week's close here today, I wouldn't be surprised to see a little bit more follow through and potentially get this thing kind of catching back up to what gold has been able to do for much of the year.
But what about the dollar? The dollar got crushed today while the equity markets were sharply higher. I thought maybe that would offer a little more support here on the grain sector.
Yeah, you would have thought so, but you could certainly see the correlation with the weaker dollar and the precious metals. That's probably a more closely watched inverse correlation there, and that was very, very evident. I think looking at the grain markets, we probably had a lot of traders just kind of sitting on their hands waiting to see what the Pro Farmer came out with this weekend, as well as what that weekend weather holds more particularly for the soybean market. But if we do start to see the dollar show more of a trend of more downside pressure, potentially that adds a nice little tailwind to the grain market. But when you're talking about the dollar and commodities, I would say the precious metals are going to be the one with the higher correlation.
All righty. Well, I'm glad you made it through the tour safe and sound. You're back, and now you can maybe get a little rest here this weekend. It's good to hear from you again. And thank you, by the way, for all the reports that you did during the week from the field, literally from the field. So great job out there. I think we all appreciated it.
Thank you. It's fun to do it, and yeah, I guess we'll be counting down the days till the next one.
All righty. So now we'll talk with you with a clean slate coming in on Monday. Everybody will have a lot to think about over the weekend. I appreciate that very much, and we'll talk with you again next week. That is Oliver Sloup of Blue Line Futures with us, and that is a look at markets on the move, which they certainly have been this week. Appreciate that very much. We'll see you next week.